over 2 years for our work in guiding you on this kind of thing. So this is where just a focus on what you're paying for fee maybe loses sight of how all of this works for you, because our job is to try to get those prices down as much as possible. I wanted to touch briefly on the concept of accrued interest, because this is also involved, and then we've had a number of questions around this issue as we talk to directors and managers and staff members. Remember, bonds typically pay interest semi-annually, so we talked about an interest payment on February 28th and an interest payment on August 28th. But the fact is that each day you earn interest on every single bond that you own. So in our example, we got the $100,000 2% bond, pays $1,000 today, or it's issued today. So as of today, there's no accrued interest on that bond. Tomorrow, it will accrue $555 cents of interest. That's $1,000 that's going to earn over the course of the next 6 months divided by 180 days. So it's going to earn $5.55 of interest tomorrow. And that's going to happen every single day until it next pays interest of $1,000 on August 28th. So that's how interest accrues every single day. But the question is, what happens to this accrued interest when you go to sell or buy the bond? So this bond's earning interest every day. What happens to that accrued interest? Well, the answer is it gets calculated and included as part of the purchase price. So you're owed that money even if you sell the bond in between interest payment dates. So here's how that works. Let's say you got this bond and you decide to sell it, your $100,000 bond, on March 20th for $103,000. What is going to be your total purchase price? Well, of course, we decided to buy that $100,000 bond for $103,000. But we've also got accrued interest, so we earned $5.55 per day, and there's been 20 days since the last interest payment, so that totals $111. So at the time that that bond is sold, the purchase price is going to be $103,111. So $103 for the original bond, and then $111 of accrued interest. That gives rise to the concept of purchase interest. The $111 that you paid is called purchased interest because you purchased that at the time that you acquired the bond. There have been some questions about what the proper accounting treatment of this is. We've had people that have recorded this as a negative income item. We've had people that have ignored it until they actually received the $1,000 interest payment on the bond. The proper accounting treatment is that this $111 should go on your balance sheet, not on your income statement, but it goes in your balance sheet as an asset. It's an asset receivable. You're owed $111 out in the future. And then what happens when you receive the $1,000 interest payment on August 28th is $111 of it goes to eliminate your asset receivable, and then the other $889 posts as interest earned because you didn't own the bond before March 20th, so you're only entitled to actually earn the interest from March 20th until August 28th, and that's this $889. So that's typically how these transactions are supposed to be handled when it comes to purchasing accrued interest in a transaction. I wanted to comment briefly on some generalizations about yield. Generally, longer maturities are going to yield more than shorter maturities. So if you're willing to buy a bond that's 20 years until maturity, you're probably going to get a little bit more yield on that than you will get on something that's only got 5 years to go to maturity.